back to my channel. Keisha here. Today we're going to do part 2 of the 3-part series around the new Tax Cuts and Jobs Act that was passed in 2017. We're talking about how the tax cut impacts small businesses or large businesses alike. Okay, so we have a lot to unpack here. Let me just give you a quick disclaimer. This is meant to be an overview, a high-level overview of the changes to the tax law that impact you as a business owner. For more specifics on how the changes impact you directly, please consult with your tax advisor or your accountant. Let's get started here. So we're going to talk about the new tax brackets. For C corporations, the tax rate has been dropped to 21%. That is down from 35%, a 14% decrease. Wow, that's like giving me a 14% raise. So businesses were able to take this into consideration in December. The tax law was passed in December, and so most businesses, especially large corporations, operate on the accrual method. So they were able to show a 14% increase in their net income, in their earnings, because they did not or do not have to pay those taxes due to the tax law changes. So what you saw was a lot of companies, because their earnings went up due to this change, they went out and started giving their employees bonuses. They wanted to share their newfound earnings with their employees, and so they started giving $500, $1,000 or $1,500 bonus checks the end of last year or early this year. So that's what that's all about. Small businesses got a nice bump, or I should say a deduction in their taxes with this new tax law. So that's one change. And the 21% tax rate does not expire. Unlike the individual tax rates that expire in 2025, these changes for small businesses and large businesses and corporations alike are not set to expire. So that's great news if you are a business owner. This is a great time to be a business owner, by the way. So the next tax rate that I want to talk about is for pass-through business owners. So the new rate for them, or because they didn't really get a rate change, there's a new 20% deduction of net income that effectively reduces the tax rate for pass-through business owners to reduces it to 29.6% from 37%. And so that's going to be our next topic, the pass-through business owners. All right. So like I said, it's a great time to be a business owner. If you are if you're a partner within an LLC, an S corporation, partnership, a sole proprietorship, or just a regular LLC without a partnership, even if you're not incorporated, if you're a freelancer, an Uber driver, a photographer, you're going to benefit from the new tax law changes. All right. So let's say you file a Schedule C or a Schedule K1. This pass-through deduction is going to benefit you tremendously. And you can take this deduction even if you took the standard deduction, even if you take the standard deduction on your 1040 going forward. So let's talk about the pass-through income. All right. So this overhaul created a new deduction of 20% of net income for many pass-through business owners. And you can see in the slide here how it works. Still not sure what the form will look like to take this into consideration, or how the government is going to come up with the calculation to make this work. But just know that if you own your own business, if you have income that is not W-2, you're going to be able to take this 20% pass-through deduction. And it starts to phase out, as you can see in this slide, once your income reaches a certain threshold. So pass-through owners can claim a 20% deduction if their taxable income is under $315,000 for joint filers, or $157,500 for single filers. Above that, the new law starts to phase out and apply limits. So this is great news, I believe. And this slide that you see is compliments of the Wall Street Journal. So if you are in business for yourself, this is the tax law has lots of goodies for you. So the 21% tax rate for corporations, the 20% pass-through deduction for others, LLCs, S Corps, so on and so forth. We mentioned it already. Let's move on to the next item on the agenda, which is depreciation. Yes. So, business buying equipment will get an extraordinary new benefit from the new tax law, the ability to deduct the entire cost of their purchases in the first year. So this 100% bonus depreciation is temporarily back. It's similar to the bonus depreciation that's been around for about 20 years. Firms can write off the entire cost of qualifying assets that they buy and place in service after September 27th, 2017. It generally lasts until 2022 and then begins to phase out 20% for each year thereafter. So the government is trying to give companies incentives to make all kinds of investments to improve the productivity and the output of their business. They're really trying to incentivize companies to stimulate the economy by growing their businesses, investing in their businesses, hiring people, and so on and so forth. So this depreciation, 100% bonus depreciation is a good look for businesses and corporations alike. All right, the next item on the agenda is the higher cap of expensing business assets. So this also ties sort of into the bonus depreciation. So there's a higher cap on expensing business assets. If you don't want to depreciate them with the bonus depreciation write-off, you can just expense them directly. You're not capitalizing them. You're just going to expense them directly, and the maximum amount that a taxpayer can expense for a new or used business asset instead of depreciating them is $1 million. So again, that's another nice treat that the tax law provides. And we're talking about property improvements, equipment purchases, purchases of property themselves. And the last big bonus that businesses are given through this new tax law that I want to talk about is for business vehicles. So buyers of business vehicles get a lot of juicy tax breaks under this new law. Let's talk about that really quickly. So if you buy a business vehicle that's placed in service after 2017 and for which 100% bonus depreciation is not claimed, the first year's ceiling is $10,000. The second and third year caps are $1,600 and $9,600. After that, you can depreciate $5,760 for that purchase of that business vehicle. So again, you're allowed to just depreciate more of your business vehicle, your business expenses, business assets in the first few years of the purchase instead of spreading it out over 5, 20, 37 years or whatever, depending on the type of asset it is. So you're getting to expense things up front immediately at once and take that huge deduction in the first year or spread out over a smaller time period. That's really all that I have for the small business tax breaks as required or being implemented by the new law. The big thing for me that I'm going to benefit from, and probably a lot of you, is going to be that 20% pass-through deduction. If you're not sure how it's going to impact you directly, please, like I said, consult with your tax advisor or your accountant. If you don't have one, look me up. I'm out here ready and available to help you. That's it. See you next time. Look out for part 3 of the Tax Cuts and Jobs Act of this series, and I think you'll like part 3. There's a lot of other nooks and crannies that weren't discussed in part 1 or part 2 that may be beneficial to you. Until next time, take care.
Expressway, head back, weaving through the traffic.